Right now it's time to welcome Sound Income Strategies representative, as well as a good friend of ours, Michael Stewart. Michael has nearly 20 years of experience in the financial services industry. He's founder of Crystal Lake Tax and Financial Group in Crystal Lake, Illinois. Mike specializes in serving the tax and financial planning needs of clients that are in or near retirement age. That's why he's the perfect guest for today's show. He's a highly sought after speaker, co-author of the book entitled Purpose-Based Investing, 9 Lessons to Rescue Your Retirement from Wall Street. And he's also the co-host of the Retirement Matters podcast. Mike, welcome to the show.
Thanks for having me, Dave.
So, we were just talking a couple days ago over the phone about the economy and so on. So why don't you share some of your basic thoughts about what you see in the economy now that we're in 2019 with our income generation viewers?
As we basically are early on into 2019, I do have some reservations and concerns about what's going on in the economy. Primarily, you take a look at where the yield curve is, it's relatively flat. We have a lot of indicators kind of flashing warnings out there, whether it's transports, small caps, even taking a look at slowing earnings in the U.S. as well as internationally, heading towards a recession on a global basis as well.
So earlier in the show, as you heard, we talked about the yield curve, how sometimes the yield curve can actually be a symptom of lack of growth and of a recession, but sometimes it causes a recession because the yield curve flattens because of external forces, such as the residual effects of quantitative easing here and abroad. And then as a result, that symptom actually causes the recession because banks shut down lending. In this case, what do you think the flat curve is? Do you think it's the symptom, or do you think it's going to actually cause the next recession?
I think with the Fed's involvement with some of the things they're doing on quantitative tightening, it actually could be the cause of going into recession, really in 2 different areas. The first one is the Fed, although publicly recently they've said that they're going to be data dependent on how they raise interest rates, and they call for 2 rate hikes this year, although the market's pricing in none. So they could raise us into an inverted yield curve, which would speed up our entry into a recession with the slowdown in lending. The second thing is, with them rolling off nearly $50 billion every single month, kind of unwinding their balance sheet, that alone, if supply exceeds demand, that alone might push rates a little bit higher and also invert the curve. So there's definitely some concerns there.
30 seconds we have left in this segment, though. Why hasn't that pushed long-term rates up significantly yet? They've been rolling this $50 billion off every single month. Why hasn't it had that effect so far? It's supposed to, right?
Yeah, it should have. And even just the increase in interest rates, you would expect at longer term rates, if we truly were in a robust, healthy economy, then long-term interest rates should be going up. The dumping of all these extra securities into the market at about $50 billion a month, should have also, in addition to regular rate hikes, pushed rates up. So I think it's really the credit markets saying that we don't believe the Fed and we don't believe a lot of the backward-looking economic numbers.
The old story, the bond market's smarter than the stock market. Michael, stay with us. We'll be right back with more on the income generation. Now it's time to welcome back my good friend and Sound Income Strategies cohort, Michael Stewart. So Michael, let's pivot to the stock market then for a moment. Why has the stock market been able to shake off a lot of the bad news, it seems, even when we almost got down into bear market territory? Now we bounced right back and we're starting to get somewhat near previous highs again. Why does it seem like the stock market isn't agreeing with the bond market?
I think it's a function of kind of a short-term memory. If you think a lot of individuals for the past 9 years, with the exception of right in 2018, the market's seemingly only gone up. And I think it's short memories of investors that markets really go both directions. They go up and down. So, for the last 5 or 6 years, you've been rewarded for buying on the dip. So people have been conditioned to go in and buy every time the market sells off. And I think we've seen a fundamental change start. We were in some oversold conditions just coming off of post-Christmas, but I think we're starting to run into some headwinds currently.
And this is kind of common, isn't it? I mean, you remember back, in 2007, it took till November of 2007 for the markets to start to react to the subprime crisis, even though you and I knew that it was there in February or March. It took maybe an 8-month delay. So you think maybe that's what's happening now, is the news is out there and the market's just trying to hope and grasp for a higher level, and then maybe more third quarter of the year we'll actually see a slide? Is that possible? What are your thoughts?
I think it's absolutely possible. And, we're counseling with some clients lately is we'd rather be a little bit early, kind of seeing some of the warning signs about recession down the road, whether that's late 2019 or 2020. And we'd rather be a little bit early in position to not be harmed by any kind of economic downturn that's forthcoming and actually be able to use it as an opportunity rather than be harmed by it.
So in a nutshell, you think, it sounds like you think, and I don't want to put words in your mouth, but it sounds like you think that 2019 will probably end the year with the stock market somewhat lower than it entered the year. Is that your thought?
It would not surprise me at all. Between the Fed's movements and then just some of the ongoing global weakness that we're seeing, it's all going to come to a head relatively soon.
And the longer we have a trade war and the longer we have a government shutdown, the greater the probability. So Michael, stick around with us, if you will, for one more segment. And you stick around with us too. We have many more words of wisdom here from my good friend Michael Stewart. You're watching The Income Generation on Newsmax, and I'm David Scranton. We'll be right back. Welcome back to The Income Generation. I'm David Scranton, and I'm here with a good friend and Sound Income Strategies cohort, Michael Stewart. So Michael, right before the break, you agreed that there's a high likelihood that the market ends 2019, the stock market that is lower than it entered 2019. I think it's possible that this could be that third major drop that you and I talk about frequently, that historically almost has to occur in any long-term secular bear market cycle, a drop of at least 40%. What are your thoughts on that? Is this it?
Yeah, if you look at stock market history, it's got to be coming. So, we've gone nearly a decade. I mean, if you just look at just not only stock market history, but the economy itself, typically every 4 to 6 years, we should have a recession or a bear market. And we're 9+ years in. So we're long in the tooth regardless of this. So, but once again, if you look at stock market history, it says that a third drop's coming, and we're a lot closer than we were a few years ago.
So now let's bring it down to grassroots. What I love about you is you've got your boots on, you're in the field talking to clients like I am every single day. You're not some economist up in an ivory tower talking theory. So what do our Income Generation members need to know? What do they need to hear from you, those age 50 and over, with economic conditions the way they are today?
Yeah, really, I would kind of look at three different things, really. The first thing would be, much like we had talked about in a prior segment, that we're 9 years into a recovery. So whether we think this is the next big drop or just going to lead into a normal recessionary bear market type of approach, it's better to be proactive and be prepared, and kind of capture some of those gains that we've been fortunate to get the last 9 years. The second thing is really a shift, especially for those in their mid-50s to early to mid-60s, is really focused more from that accumulation mindset that the stock market's the only place to get return, more into kind of a distribution and income mindset, to where you can get a little bit more sustainable, predictable yield and gains on your returns, rather than essentially only hoping that the market goes up as your only strategy going into retirement. And the last thing, probably the third thing that's critically important, is really having a great grasp on the difference between your risk tolerance and your risk capacity. So risk tolerance is, yeah, I understand the market fluctuates. Risk capacity is, now that you're in your 50s or 60s and you've amassed the largest part of your net worth and retirement savings, what do you have capacity for losses? Because those losses at the late stage of the game here are going to be more impactful than the potential gains that you might get on a go-forward basis. So I would kind of put my arm around all three of those and just make sure on a risk-adjusted basis that I've been proactive as far as protecting my assets as I get closer to retirement.
A man after my own heart. No wonder why you and I have such good conversations all the time. Most important question, 10 seconds. You ready? Who's going to win the Super Bowl?
Patriots.
Patriots, all right. Go Patriots. You just made enemies of probably 3/4 of our viewers. Michael, thanks so much for being on the show today. Really appreciate you being here.
Thanks for having me, Dave.
And you stay with us. We'll be right back with more on the Income Generation. I'm David Scranton. Stay with us.